Hello students, today's live lesson will cover selected important topics from Lesson 2. I hope I can emphasize information that will assist you in comprehending the learning objectives and provide real-world applications. The learning objectives of each lesson are a useful tool to ensure comprehension of key concepts. First, let's briefly review the learning objectives of Lesson 2. The learning objectives are: differentiate between entrepreneurship and small business, identify the steps and success factors in starting a new business endeavor, describe each type of business organizational structure, identify major issues involved in creating and managing a corporation, and identify challenges and barriers associated with doing business internationally. We will be reviewing business organizational structures and issues involved in managing a corporation in this live lesson video. The material in this live lesson correlates with textbook pages 72 through 79 in Chapter 3. Businesses can generally be separated into two groups: non-corporate and corporate. Non-corporate business ownership includes sole proprietorship, partnership, and cooperatives. Table 3.1 on page 72 in the textbook is an excellent chart to compare each business type. We will also review many types of corporations, including private, public, subchapter S, limited liability, professional, and multinational. Now let's discuss the first type of non-corporate business, a sole proprietorship. The sole proprietorship is owned and generally operated by one person. Advantages of this type of business are freedom, ease of formation, simple legal setup procedures, low startup costs, and tax benefits. A sole proprietor can cut their taxes by deducting business losses from income earned from personal sources other than the business. Disadvantages include unlimited liability, lack of continuity, and dependence on one person for managerial and financial resources. Unlimited liability means that a sole proprietor is personally liable for all debts incurred by the business. Lack of continuity means that a sole proprietorship legally dissolves when the owner dies. Our next type of non-corporate business is a general partnership. General partnerships are owned by more than one person, and partners may invest equally or unequal in terms of sums of money. Distribution of profits may be based on the amount of investments or other things, such as labor or name recognition. One advantage of a partnership is the ability to grow by adding new talent and money. The legal requirements to start a partnership are few. Disadvantages include unlimited liability and a lack of continuity. Excuse me. Each partner is liable for all debts incurred by the partnership, even if they did not know about or agree to the new debt. Furthermore, there can be difficulty in transferring ownership, since no partner may sell out without the consent of the others. There are some alternatives to a general partnership. A limited partnership allows for limited partners who invest money but are liable for debts only to the extent of their investments. However, these limited partners cannot take active roles in business operations. This type has a general partner who runs the business and is responsible for its survival and growth. Another type is a master limited partnership, in which an organization sells shares to investors on public markets. Investors are paid back from profits, and the master partner retains at least 50% ownership and runs the business. The master partner must regularly provide minority partners with detailed operating and financial reports. The final type of non-corporate business that we will discuss is a cooperative. Cooperatives combine the freedom of sole proprietorships with the financial power of corporations. They give members greater production power and greater marketing power, but are limited to serving the specific needs of their members. Ocean Spray is an example of a cooperative. We will now discuss corporations. Corporations are only 20% of all U.S. businesses, but account for over 85% of all sales revenue. The largest corporation is Walmart. Walmart has over $408 billion in annual revenue. A corporation, by definition, has legal status as separate entities, property rights and obligations, and indefinite lifespans. The U.S. Supreme Court defines a corporation as an artificial being, indivisible, intangible, and existing only in the contemplation of the law. Corporations can perform the following activities: sue and be sued, buy, hold and sell property, make and sell products, and commit crimes and be tried and punished for them. We will now review the advantages and disadvantages of incorporation. Advantages include limited liability, continuity, and ease of raising funds. Limited liability means that investor liability is limited to personal investment in the corporation. Corporations have a legal life independent of founders and owners, since shares of stocks may be sold or passed on to heirs. Disadvantages include a potential takeover by shareholders, larger startup costs, heavy legal regulation, and double taxation. Double taxation means that a corporation pays income taxes on company profits, and then the stockholders pay taxes on income returned by their investments in the corporation. Now I will describe the various types of corporations. In a private corporation, stock is held by only a few people and is not available for sale to the public. In a public corporation, shares are publicly issued and widely held. The subchapter S corporation is a hybrid of closely held corporation and a partnership. It is organized and operates like a corporation, but it is treated like a partnership for tax purposes. A limited liability corporation is also a type of hybrid, since owners are taxed like partners but enjoy the benefits of limited liability according to publicly held corporations. Professional corporations are usually composed of doctors, lawyers, and accountants. The corporate structure protects them from unlimited financial liability, but cannot protect them from personal liability on the individual's part. A multinational corporation spans boundaries, such as different exchanges or countries. This link provides a fun, succinct summary of business organizational structures. While it is similar in nature to the content we have discussed thus far, the Young Attorney provides additional relevant detail. Our next topic for this lesson will be managing a corporation. Corporate governance is the role of shareholders, directors, and other managers in corporate decision-making and accountability. Corporate governance is established by the firm's bylaws and usually involves three distinct bodies. Stockholders are the owners of a corporation. In other words, the investors who buy ownership shares in the form of stock. Profits are distributed among stockholders in the form of dividends, and corporate managers serve at stockholders' discretion. The board of directors is a group elected by stockholders to oversee corporate management. They are legally responsible and accountable for corporate actions and are increasingly being held personally liable for them. Corporate officers are top managers hired by the board to run the corporation on a day-to-day basis. The team of officers is headed up by the firm's chief executive officer, or CEO, who is responsible for overall performance. Finally, I will briefly define some special issues in corporate ownership. A strategic alliance is when two or more organizations collaborate on a project for mutual gain. When partners share ownership of what is essentially a new enterprise, it is called a joint venture. An employee stock ownership plan allows employees to own a significant share of the corporation through trust established on their behalf. Institutional investors control large resources, such as mutual and pension funds, and can buy large blocks of stock. A merger occurs when two firms combine to create a new company. An acquisition is when one firm buys another outright, usually with one firm controlling the newly combined ownership. Mergers and acquisitions held companies increase product lines, expand operations, become international, and create new enterprises. When a corporation sells a part of its existing business or set it up as a new and independent incorporation, the sale is called a divestiture. When a firm sells part of itself to raise capital, the strategy is known as a spin-off. The following link is a very well-detailed, useful video comparing mergers with acquisitions. I have included it because I feel that these two terms can be confused easily. I have created a small Check Your Understanding section similar to the online presentations to help you verify your comprehension. You can also review the answers on the next slide. Thank you for watching today's video. Please reach out to me via the chat room or email if you have questions. Have a wonderful day.